Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, January 5th, 2023. I'm going to go over the equity markets. I'll be very brief. I've done extensive coverage on the equity markets lately, so I'll just be quick there. Really, today didn't tell us much. I thought we'd get a definitive break from these trading ranges. Still haven't had that yet, so we'll wait and see what tomorrow brings. I'm going to give you a few new trade ideas, a couple individual stocks, some to watch, some sectors to watch as well, and updates on silver, gold, the U.S. dollar, and just a general commodities update. All right. Starting out here, QQQ, these are the what I call the Christmas trading ranges, really all from mid-December right here. Most of these ranges run from mid-December until current. So QQQ is pushing the bottom end of that range, but really not a this is certainly not a definitive break. We pretty much parked right about at the bottom of the range, not far enough away from there. To consider that a breakdown, especially in light of the fact that the other indexes, most importantly the S&P 500, are still well within those ranges. This is SPY. And by the way, that was a 60-minute chart on QQQ. This is a 60-minute chart here on SPY, and you can see you have both an uptrend line right there, and the same charts I got out to you this morning. And then the bottom of the range comes in at about 377.50 right there. So it's simple stuff to me. I mean, break down, and that means get short or be short. And until and unless we reverse back into the range, and my midpoint area will be for a stop, and out of any shorts taken, if we do break down there, we'll be able to move back above. Likewise, an upside break of the range would mean the same thing. Probably take us up here, somewhere in that area. I've covered upside targets, especially in QQQ and the small caps. That's what I'm favoring. And then the same thing, if we get a whipsaw, meaning a breakout and a reversal back in, you could certainly have a tighter stop, at least maybe down a quarter into the range. It's not uncommon when you break out of a range to back test it, maybe slightly undercut on a back test. That's why you want to give it a little room. And again, stops are always, or should always be, commensurate or relative to your price target or targets. I say price target. Some people scale out, take profits at certain levels, and some people have just one sole price target. So if you have multiple targets, you just take your average cost basis, or you also can stagger your stops in multiple lots as well. If you plan to scale out, you could have a stop there. If you take it, let's say we break to the upside, another stop there and another stop there, or wherever you want. And last but not least, IWM small caps, same thing. Just I always refer to these trading ranges like a coiled spring building energy, and that's from my experience usually what you get once you have a definitive break out of these ranges. The move can be pretty powerful and swift. So as I said this morning, just don't be married to any one thing. The market must do this or that. With the positive divergences, although there's a lot to not like or to like if you're bearish on the long-term charts, not a lot to like if you're bullish. There's still, it's a mixed bag right now, and that's what I'm going to show you in these trade ideas too. There's some stocks that look good that I'll share as long trade ideas, and some that look bearish. All right, enough on that. Told you I wasn't going to spend too much time on the market. That's that. We're going to see which way these things break, and then that we should get the markets to get going here one way or the other. And let's go to let's do an update on gold and silver next. GLD gold is still, this is a 60-minute chart. It's still diverging. I still think we have a correction coming. I remain longer term bullish in gold and silver, just looking for a correction based on several factors. This is a very busy chart. Because I have lines on here I've had forever and a day. But if you're new to the site, or if you haven't seen my analysis on gold recently, this was a big level to me at about 157 or so. It was the bottom also of a big support buy zone. About here it's 158. And then what had happened is you had a breakdown that I suspected would prove to be a false breakdown, aka bear trap. You went down below. You had positive divergences. Similar to how you have positive divergences on the 60-minute chart of the indexes now, but this is a daily chart. These divergences showed through on the weekly, and once you made a solid recovery, you had one little punch in there, but that didn't do the trick. It was this one here, and then the gap up, and that's of course been the catalyst for a rally, and this will typically have much longer term bullish implications, and for many reasons I've stated, both fundamentally and technically, that's remain longer term bullish on gold. However, nothing goes up forever. Even in a bull market, you're going to have corrections. This has been really a high level correction here. You go back to the weekly chart, roll back all the way. This is the previous bull market in gold here, and you can see, corrections along the way. Nothing goes up forever. That's where the bull market ended. Then we had a bear market that ended in December of 2015 right there. That started a new bull market. But as I was saying back then, my big level back then was 130. We were consolidating. Here's a good example of that coiled spring, building energy, pushing on 130. And then when we got that buy signal, that was really the catalyst that gave us the most powerful thrust up in this bull market. Again, that started all the way back here. That was a low. It just based for a while, and then took out that base and exploded higher. And I still view this as, bull market consolidation, and likely to see ultimately new highs. Remember that last high right there? We have pretty much a triple top, if you will, in gold right there. So if and when we go to take that out, which I think will come over time, that's going to be pretty bullish for the next leg up and all-time highs in gold. But that's longer term picture, and you can certainly trade and position on that. But near term, watch this uptrend line. I have a couple trend lines on gold. On GLD, you can draw a trend line off the lows there. You only have a few reactions here. It's not my favorite. I also have this price channel. This is the one I showed most recently, this uptrend line here. That's the same one on the 60-minute chart. So you have a little price channel there, and negative divergences. And we did, although we don't have a solid breakdown, there's a potential reversal, hanging man doji there, gap up, gap down. But gold's always gappy because it trades around the clock. Gold future trades around the world, so you're always going to get gaps in GLD, or quite often. But what we do have a pretty solid sell signal on, I gave you this setup recently. I told you silver would trigger a sell signal to break below this bearish rising wedge. This is a daily chart. You had some divergences building, and then boom, we broke down today. Actually, yesterday, there was your breakdown candle that closed below it, and you also had this downtrend line off the highs, which silver rallied into. Again, it's been a nice run. You came off this divergent low here. Silver rallied about 36%. But like I said, ran into resistance just like gold. I should have mentioned that back there as well. These are lines I've had on this chart a long time. 171 to 172 is a resistance zone, and so it's that. And finally, including but not limited to my analysis on the US dollar, I told you I have a pretty good, called for and traded this, pullback. This was the catalyst. Gold moves inversely to the dollar. This was the catalyst for the rallying gold and silver, but we've fallen now. The dollar has fallen to really good support there, the dollar index. And I could see, and I put coin toss odds, well, then maybe get one more thrust down. If so, you're going to hit this trend line. You have a nice uptrend line. We came close enough to it that might do the trick, or we may make one more thrust down. Either way, we're not talking a lot here, so we came very close to it so far. I think we'll probably get a rally here, and if we do get a thrust down, it happens to take out the trend line. Next support there is on the dollar index, 12,628, and that would set up the one thing we don't have now for a bigger rally in the dollar is positive divergence, but we would should we get one more thrust down. So I'm kind of leaning towards that. You probably wouldn't want to go heavy short silver gold. The best takeaway, if you're a swing or trend trader, maybe just look to position on pullbacks. Silver futures, I gave you this similar wedge here, and it's nice and clean on SI silver futures. This is a 6-month 2-hour candle chart. There's your divergence. It's a bearish rising wedge pattern with negative divergence, and that one broke down. You can see, and I told you that you break of the wedge would be certainly a sell signal, but the benefit of the doubt level, you had some price support there at 23,658 that was also taken out. So silver is on a sell signal, and could backtest the wedge. If the dollar takes that last thrust down and we get a little more upside in gold and silver, you could look to short if you're an active trader, backtest the wedge. Otherwise, I think we're going to come a little lower, and these are the levels I'd be a buyer in silver. And if it gets ugly, we can come all the way back here to 21.15 or so. And again, Depends how the charts look if and when we get there. But as of now, those are potential downside targets. Let me do a quick run into commodities. DJP for a while now has been my commodity proxy, or even my inflation proxy, because it is one of the most balanced and diversified commodity ETFs out there. There's some others, but this is the one I focus on. And way back here we had a breakdown. We put in divergent high. We've moved down, and I've had this 31-ish level here for quite a while. I even had back here some arrows drawn us down to that level, and it's a level that we're probably going to get to now because we took out, I had support here at 32.41. We took that out, and if and when we get there, we're going to, well, actually, let me take that back. We already have positive divergence right there. The prices are making a lower low, but the fact we took out support, I could see a little more downside there, and that divergence will still be very much intact. So I am still a believer in the commodities are in early stage bull market action. This is what it looks like since COVID hit, but when you go back a lot longer than that, the commodities bull market, previous one ended in 2008, and they've been on a vicious bear market, an unusual one too, because usually commodities go up with the stock market, but they, unlike the stock market, they've been in a decade plus long, 20, over 10-year long bear market, and then by every metric and technical analysis, higher highs and all that good stuff, this is early stage bull market action, taking out all these previous lows. So anyway, so there it is. You can also see support here. It's about $31 there, and that looks like a good buy point if you're looking to get into commodities. That's a pretty decent support. If we get an ugly correction, and it's certainly possible, 28, that's almost $26. That's even better support. Better because you have more reactions there. And just for kicks and giggles, let me throw up some fibs here on it. Fibonacci retracement levels, and see where that would take us. So here's the fib numbers. This is the 38.2%, usually a minimum Fibonacci retracement. We're right at it right now, so that is a typical retracement in an uptrend or a bull market, a 38.2 of the whole run. The 50 is right here. There's a dashed line right there. And then look at that, never fails to amaze me. That 61.8 comes right in with that 25.88 or 26-ish target right there. We'll call it 25.26. And so again, that would be a max, likely, there's no guarantees, but a maximum pullback target. And this would be minimum, about where we're at, maybe a hair more downside. And then that's when like I said, you can look to re-enter or take new if you missed the initial run in commodities. That's where you want to look in. And it also fits in with my thesis or working theory of the whole what I call the negative feedback loop or vicious cycle between commodity prices, inflation expectation, and what the Fed's going to do. So we have been, commodity prices have certainly been falling lately, and that's going to, overall, it helps the Fed become not as hawkish, less hawkish, or more dovish, however you want to call it. And but ultimately, when we come up here, that's going to give us the next thrust up or a leg up in inflation and commodity prices, and that will probably coincide with the next major leg down in the stock market. So that's, again, general commodity ETF, and there's some levels and developments to watch for. Right now, throughout, one of my favorite at this point in time, and that is the natural gas. It was a setup as of last week, I think I first threw it out here. This is a 5-minute chart. You can see it broke out of this. This is about, I give it to you, right off the lows today, and it broke out of this little wedge with positive divergences. And again, that's only a 5-minute chart. If we can get some traction here, the trade was based off the hourly chart, 60-minute candles. Look at the 3-month here, hourly, and you can see. So it was a setup and has been since about last week, pending a break of this trend line, which still hasn't come. But as I mentioned, I got the post out to you today based on the fact we are at long-term support on natural gas, as I showed you earlier. Those are the two objective levels, or two objective buy points on a long side trade. You either buy a pullback to support, which again you don't see here on the 60-minute chart. That's why I gave you the daily and weekly charts earlier. That's what we did. Or I should say, you buy a breakout above resistance, which is a downtrend line in this case. and so that would be your second buy. If you don't want to catch a falling knife, and I know many people don't like to, no problem. Then you can just sit and wait for a breakout. It's going to be a little less favorable entry, but who knows? Maybe today's trade, maybe we go down to the next support level, and then the breakout comes later. So, the thing is, take ideally a half position here and another half, take it up to full position when you get the breakout. Targets remain the same. And by the way, if that third target there is hit, that's about a 45% rally from today's lows. And that sounds like a lot if you're new to trade. If you trade natural gas, it's par for the course. That's what natural gas does. I always say it's a trendy little sucker. It's usually either going full throttle up or full throttle down, and it usually turns on a dime when traders decide the trend needs to change, and all the longs get out, and then the shorts get in, and that's it. So again, great support. I don't know, it's in free fall, but that's what it does. Just like when it's going up, it usually goes parabolic and then it just stops. So we'll see. Alrighty, next up, I think that brings us to the trade ideas. I'm just going to throw out some random ones, some that look good for longs. If you're looking for long trade ideas, Disney kind of popped up on my radar today. I was just going through stocks in the S&P 500. This is a weekly chart of Disney. You have very good long-term support here, kind of like Amazon. It's a market leader, one of the top names at long-term support. That's right at about $90 there. My level here says 89.98, so we'll call that 90. You can see how well defined that support is. We had a little 1 week drop, but followed by an instant recovery right through there. That was when COVID hit and the panic selling. So that would be, I consider that a successful defense, just a little whipsaw move, all the panic selling and forced liquidations down into the COVID lows. We cracked below it recently again, but look, we took it back this week. So if we can build on these gains, as of now, technically, I don't want to split hairs, but technically that's a bear trap because you took out the $90 level and now you've moved above it. And you also have on the weekly chart here, just like I showed you on the daily, these are the same divergences, positive divergences. So on the daily, I had this little minor downtrend line, gives us that smaller wedge. And then the target would be the primary downtrend line, which is right here. So you can see, and I haven't cleaned this up. These are old levels, but targets, let's just say kind of moving targets, conditional on the market. If we get that stock market rally, I think we might get, you look at these 200-day moving averages. They're beautiful on a lot of stocks and indexes. They act as support. That's the red and the blue line, the 200 exponential and the 200 simple moving average. They act as support in a bull trend, and once that support's broken, then they act as a resistance. And once you regain them, they're support again. So you buy pullbacks to support in an uptrend, and you short rallies into resistance or these lines in a downtrend. So we're below them now, and that's because we're in a bear market. That's what it looks like. But bear market rallies will often take you back up to that level. So there are targets if you want to trade bear market rallies, and there are also objective levels to short. And now, based on the divergences, if something wonky happens and we get a nice rally this year in the stock market, more than just the 5 or 10% that I've been talking about lately is possible. Believe me, I'm still longer term bearish. Then we could take out the trend line and take out the moving averages and run all the way up there. That would be my maximum target at this point in time. Again, it's conditional on the stock market rallying. Disney's not going up to 127.50, which is a 38% rally from where we're at today without the stock market going up. I can all but assure you that. So that's just one of many, and I'm throwing out trade ideas, especially it's it's steady, well, blue chip stock. MKTX. I mentioned this one back last month, and it's one I've followed and traded over the years and kind of got away from for a while. They deal with trading treasury bonds, and for a while they've been going down quite a bit because the Fed was the only game in town with quantitative tightening. They were really the only buyer of treasuries for a while, or the largest buyer. But now, we're seeing them, they reversed from that, and we're seeing now, well, the setup is there. Let me just say the setup is there, and I think they're going to see, as bonds become more tradable vehicles as they have been, uptrends and downtrends. they may benefit. And there was also something in an article, and I cited that last month when I went over this stock as a setup back. I forget where it was. It was here, or it just broke out, one of the two, um, where they're trying to shift, to kind of diversify the markets for trading treasuries. And you can see this one had, as I believe I mentioned back then, at about right here is about 291. It's got pretty good resistance and a downtrend line, and you can see it popped it today. So it is a breakout. It's clearly above it, and I don't certainly not run away. It could be a little whipsaw, but if this one can build on these gains tomorrow, or even open around where it is, even a back test of the trend line, I think is objective long entry. You might, like everything else, see if you can put an uptrend line below the low. So keep it, tight stop, not too far below this uptrend line. There's your minimum target. I'd see nothing less. That's about 336. A little shy of that. That would be a minimum bounce target, or swing target, I should say, not a bounce target. That's about a 14% gain. So let's just leave it at that. Okay, that's a long trade idea. And then, I'm looking at sectors that look a little weak right now, and one of those would be the healthcare sector. This is the second largest sector in the S&P 500, so this makes it hard to get too bullish on the stock market. Just like the S&P 500 and the small caps, a lot of indexes, they put in this big topping pattern. The indexes did, the S&P before it broke down. The healthcare sector has held up relatively well. That and the energy sector have been probably the two strongest sectors in the S&P 500, and I've covered this many times recently. You had in the last year and a half, that range goes all the way back to about May of 2021, I'm sorry, May of the last year before last, so about an 18-month range. And we had two and now three false breakouts above there. Again, I've covered this quite a bit, including recently, with little trend lines to signal short entries. You had divergent highs. These were breakouts that nobody, in my opinion, should have took. They were breakouts that all occurred with negative divergences, and right after that, they all broke trend line support, just like here, no different. And likewise, just like this breakdown had positive, aka bullish divergence, just like the market did. So that's a breakdown that shouldn't have been shorted. And it was held at support end, right, 121. Now, so there was the divergent high, the wedge breakdown, impulsive selling, and it's been in this little trading range right here. As I said, the MO has been when you enter or break above this range, or any range, if you re-enter, you usually go right back down to the bottom. And this is what happened here. We got in the Christmas trading range, like the markets. Everything went sideways for a while. Bottom line, if we break down there, really below the recent lows, about 134 or so, that will most likely bring us down to the bottom there. However, this could go either way. I personally, this is an ETF that I don't trade because some ETFs, I'll give you examples, like GDX, gold mining ETF, birds of a feather flock together. They all do the same thing. You look at the gold mining stocks, when GDX is up 5% on a day or 4%, it moves pretty good. All the miners are up, just about all the components of it, the big miners. And likewise when it's down. Healthcare is a different story. In here you've got health plans, United Healthcare, you have pharmaceutical companies, biotechs, all different things, and they each have their own pipelines and their own drugs out there, or unique dynamics such as United Healthcare. And so I just want to point that out. This is one that just recently broke down. Could have sworn I had a price alert because I've been tracking this stock for a long time, waiting for the breakdown, and I didn't get the alert yesterday, and I picked up today. It's already hit what would have been my first target there, 488. Either way, it's a breakdown. What I'm trying to say, that's a long-term trend line. It came after divergent high. This stock, in my opinion, is headed lower. Sorry to give you a couple long side trade ideas. Here's one's bearish. Took out look at the 200-day moving averages. If you can see them, the red and blue lines right there with the along with the trend line, and it took all three out in one fell swoop. So that's a sell signal. At best, maybe a back test, and that's why I'm sharing the trade idea. And then you could short that for the next leg down. 448 would be your next target. Then 422-ish. 423 we'll call, and at this point in time, my maximum target be 387. Now, if and when it gets there, it's going to be conditional, largely dependent on what the stock market does. But just wanted to share that one and kind of give you an overview. I'm just going to rifle through. These are the components of XLV, the healthcare ETF, in order of market cap. So UNH was the largest. This is J&J, Johnson Johnson, divergent high. There's a trend line. No sell signal yet, but divergence is building. So if that breaks, maybe a back test to this downtrend line, which it just broke above, and there's support around 172. There's Lilly. Here's a setup. This is what I would call a bearish setup. No sell signal yet. It has a divergence that's been building. This is our primary trend line. So this is the one. Let me set an alert now in case I don't have it. That one would likely trigger a pretty powerful sell signal if and when taken out. And it looks like it's probably headed that way. You can see the divergence getting a little steeper right there, increasing on that last thrust up. Pfizer, that one just broke down, rallied into resistance right there. That's pretty good resistance. That would have been an objective short at the time. And then it broke trendline support, which would have been the next objective short. It's testing the 200-day exponential moving average right now, but just trying to show you some of these stocks are breaking down and some haven't broken down yet. Merck's getting nosebleed territory here. This is negative divergence, building as the stock moves higher, and it took out this uptrend line. It's had a little kick higher. Sometimes you break a trend line, you fall. Sometimes you back test, and that's what it's doing, is back testing. So actually, it's really strong. I'd wait and see which way the market breaks here, to be honest with you, before taking any of these. But you could make a case to short it right there, or wait for any type of reversal, maybe a candlestick reversal pattern. But that is a back test of the trend line, and with the divergences, I think it's a matter of time before this one comes back down to ultimately work its way back to about 95.24. That's support level. TMO, Thermo Fisher, you can see a downtrend line. It's coming up to a little uptrend line to crack. All right, I'm not going to go through each and every one. There's Abbott, look for break of the trend line. Bristol Myers BMY just broke down from below its trend line. Amgen came back, pulled back to hit that nice support level and bounced recently. PPO is poised to make a bullish crossover, so maybe this one has some upside. So like I said, mixed bag. I just wanted to show you that, and that's why as far as where the sector goes, can go either way, but I'm leaning towards more downside in the coming months. I'll tell you for sure. The coming days to weeks, well, I'll tell you when I see which way the S&P 500 and Nasdaq 100 break out of these trading ranges. Okay, and that is it. Let's keep this one relatively short. Covered a lot of things in there, under 30 minutes. So I'll wrap it up here, get it out to you. And we'll pick it up tomorrow. We'll see if the futures move overnight. Remember, keep in mind that we are right at or very close to the bottom of these trading ranges. So the risk tonight for any type of gap or surprise is going to be to the downside, because if the futures start moving lower and take a hard down overnight and into the morning, QQQ and even SPY have the potential to gap down below. There's the magic level again, roughly about 377.50 on SPY. So but as I like to say, support is support until unless broken. So it's another wait and see day. So we'll pick this up tomorrow. If anything big is happening in the morning, I mean, you'll get up, you'll watch the futures. If the futures are down 2%, 3%, then you know that we've broken those levels, or you can check SPY and QQQ and pre-market. But anything big happens, I'll get a post out to you pre-market. If not, we'll just pick things up when the market opens. This has been Randy Finney with Right Side of the Chart. Have a great day.